G'day and kia ora everyone. My name is Sanjeev and welcome to the Engineered Investments channel. At the end of this video, you would have gained insights into evaluating bank stocks. In future videos, we'll see how this knowledge can be applied to ASX listed bank stocks. In order to evaluate a bank stock, we push it through a three-stage evaluation process. Only the fittest banks are left standing. The unwanted banks are effectively filtered out. The remaining banks are then gauged for investment suitability. The first stage is establishment. This gauges how long the bank has been in operation, its market size, and its ability to survive adverse market conditions. The second is the financials. This gauges the bank's ability to pay dividends, its share price growth over 5 years, as well as determine the operational income and expenses compared to the previous financial year. Finally, the take-home pay, how much net profit the bank has made during the current financial year. If we get past the first two stages, then we investigate the ratios, which is almost like a third-party perspective. The ratios guide us on whether the bank is operating efficiently, how well it's diversified, and the market share they occupy. Let's expand on each of these metrics to see the principles behind them. Here's a rough timeline showing adverse market conditions. They have occurred over a long period of time. What we want to emphasize are these historical events typically outline the bank's ability to navigate through tough times. The more adverse situations they have been faced usually means the longer the bank is going to be around into the future, making it a strong candidate for long-term investment. What should be noted is Australia and New Zealand's financial systems are quite sound when compared to other regions, for example, the dot-com crash or the global financial crisis. Both these events were not recorded as a recession or a depression by either the Australia or New Zealand's financial regulatory bodies. We also want to look at where the bank sits in terms of market capitalization. The bank should ideally be indexed in the top 500 ASX companies, where the indexing gives us an immediate insight into the bank's performance when compared to all other stocks currently trading on the ASX. In summary, at the end of this stage, if the bank has not traversed through tough times and is not indexed in the top 500 ASX listed companies, then they don't make it to the next stage. In the second evaluation stage, we check to see if dividend payments are being made consistently over the last 5 years. If not, then the bank is immediately filtered out. We then look at a share price growth. We want to see an increase over a 5-year period. If not, again, the bank is filtered out. In saying this, there are some occasions where a drop in share price can be tolerated. For example, during adverse market conditions, where a drop in share price could signal a time to buy. However, this would need to be balanced with the bank's ability to continue paying dividends and its ability to turn a profit moving forward. Next cab off the rank is the operating income. Operating income is the profit made by the bank after taking out the operating expenses, which in ideal circumstances should have increased from the previous year, either through expansion of business, reduction in operating expenses, or a combination of both. If it hasn't, then some annual report investigation needs to take place as to why. The operating expenses is the cost of running a bank, where you want to see that it's kept under control. If the operating expenses increases out of proportion, this could signal a problem in the bank's management. Again, some annual report investigation needs to be done. An example of poor bank management was the recent wrongful misconduct found by the Royal Commission, the conclusion of which banks had to pay heavy penalties and provide remedial work towards affected customers, the outcome of which impacted operating expenses. Finally, the net profit. This is the bottom line results the bank has achieved. The take home pay. We want this value to be in proportion to the previous year. In summary, at the end of this hill climb stage, if the bank is not able to justify its ability to turn a profit and keep its costs down, then they are immediately culled, as the probability to maintain ongoing dividend payments and show growth potential comes directly into question. On the third and final stage, we'll check the three financial ratios and two independent market metrics that provide another angle in the decision-making process. The return on assets ratio compares the net profit made to the total assets the bank owns. Bank assets are things like land, property, ATM machines, the computer systems, and so on. This ratio gives us an indication on how effectively the bank is using its assets to generate its earnings. For example, if the bank generated 2 billion in net profits using 2 billion in assets, 2 divided by 2 gives us a ratio of 1. If in the following year the same bank generated 1 billion in net profits using 2 billion in assets, 1 divided by 2 gives us a ratio of 0.5. This example indicates the bank was more efficient in the first year because it was able to squeeze out more money with the same amount of assets. The cost to income ratio. This also provides an idea on efficiency, just using different metrics. Here, the operating costs are compared to the operating income, which gives a gauge on how much money is burned in order to earn. If the ratio number gets bigger than previous years, it could suggest costs are going up faster than the profits are being made. Using an analogy, it's sort of like how much power you can pull out of an engine versus the amount of fuel it took to do it. Just a heads up, these ratios will make more sense when applied to an actual bank, which we'll cover in the upcoming videos. So don't worry if it hasn't all sunken in yet. Moving on. The non-interest to operating income ratio provides an idea on how diversified the bank's income is when it compares to the income made. Sorry, where it compares the income made from the services business to the income made from the lending and deposits business. Here, it's probably worth noting that a commercial bank's main source of income is getting deposits from savings customers, then handing it out as loans with interest to investment customers. The services income, as you guessed it, comes from services such as house and car insurance, credit cards, share trading platforms, super, and so on. The income from these non-lending outlets is referred to as non-interest income. If the ratio starts getting smaller, it could mean the services business is shrinking. And if the ratio gets bigger, it could mean the bank is losing lending customers. Finally, we tap into independent market figures, which are owner-occupied and investment home loan figures recorded by the Australian Prudential Regulation Authority, or APRA for short, where we sum up these figures to derive market share. This provides information which is not sourced from the bank's website or a share trading platform. In summary, at the end of this stage, if the bank is running efficiently with good income diversity and has a sizable market share, this information combined with stages 1 and 2 can then be used to determine a level of investment suitability. This brings us to the end of the video. We're now ready to apply the evaluation process to ASX listed bank stocks. Thank you for watching. See you next time. Ka kite anō.